Welcome to The Explainer. Today, we're talking about loans. We're going to take this thing that can feel kind of scary and turn it into a financial tool that you actually understand and, more importantly, that you can control.
You know, a loan can be this incredible force for good. It can help you build your future, grab opportunities you wouldn't have otherwise, but if you don't know what you're doing, it can also lead you down a pretty stressful financial path. The only thing that separates those two outcomes? Knowledge.
So, how do we get that knowledge? Well, here's the game plan. We'll start with why a loan is really a double-edged sword. Then, we'll break down the 4 basic parts of any loan. After that, we'll see how it all plays out in 2 very different stories. And finally, I'm going to give you 5 lenses to see any loan with total clarity, plus some golden rules for borrowing so you can write your own success story.
All right, section 1. So what's the deal with loans? Why do we see them as this potential hero, but also a potential villain in our financial lives?
And that's really the key, isn't it? Loans exist to help us make big moves, like getting a great education, buying a home, or starting a business, way before we've saved up every single penny. They solve a simple problem. The big expense is today, but our income shows up in little bits over time.
Okay, to get a handle on this tool, you've got to know its 4 fundamental parts. Seriously, every single loan, whether it's for a car or a company, is made of these same 4 pieces.
First up, you've got the principal. This one's easy. It's just the lump sum of cash you're actually borrowing. If you get a loan for 100 grand, the principal's 100 grand. Simple as that.
Next is the interest rate. The best way to think about this is it's the rent you pay for using the bank's money. It's a percentage, and it's probably one of the biggest factors in how much that loan is actually going to cost you.
Then there's the tenure. This is just the lifespan of the loan. It's the amount of time you and the lender agree on for you to pay it all back. Could be 5 years for a car, could be 30 years for a house.
And finally, we have the EMI. That stands for Equated Monthly Installment. This is your fixed monthly payment, the amount you send to the lender every single month. It's a mix of paying back some of that principal you borrowed and paying the interest you owe.
Okay, now this is where the rubber meets the road. Let's look at these 2 real-world examples. For the car loan, yeah, you pay some interest, but it's a fraction of the loan itself. But now, look at the home loan. Because of that super long 20-year tenure, the total interest you pay is actually more than the money you borrowed in the first place. That's a huge takeaway. The longer the loan, the more it's going to cost you.
So let's make this real. We're going to follow the stories of 2 people, Anu and Anish. We'll see how the exact same financial tool can lead to 2 completely different lives.
So first we've got Anu. She saw her loan as an investment in herself. That education loan let her get skills she couldn't afford on her own. And those skills led directly to a better job and a solid financial future. For Anu, the loan was the hero of her story.
And then there's Anish. He used loans for consumption, for lifestyle upgrades, things he couldn't really afford. And this created a really dangerous cycle, where one loan just led to another, and before he knew it, he was trapped in a spiral of debt. For him, the same tool became the villain.
So, the million-dollar question is, how do you make sure you end up like Anu and not like Anish? Well, you do it by looking at any loan you're considering through these 5 critical lenses.
Think of these 5 lenses as your personal toolkit, your checklist before you sign on the dotted line. Running through them will give you the full picture and help you dodge any nasty surprises down the road. Let's break them down.
First lens, purpose. This is the big why. You have to ask yourself, is this loan productive or is it for consumption? A productive loan, like Anu's, is an investment that's supposed to grow your future value. A consumption loan, like Anish's iPhone, is just for today's wants.
Second lens, collateral. Is the loan secured or unsecured? A secured loan is backed by something valuable, an asset, like your house for a mortgage. If you don't pay, the bank can take that asset. That's less risky for them, so you get a lower interest rate. An unsecured loan isn't backed by anything, so the bank charges a higher rate to cover their risk.
Third, you got to look at the structure. Is it a term loan or revolving credit? A term loan is simple. You get a chunk of cash once, and you pay it back in fixed chunks. But revolving credit, like a credit card, is a credit line you can use, pay back, and then use again. It's flexible for sure, but it takes a lot more discipline.
Okay, listen up, because this one is a huge trap. You have to ask how the interest is calculated. The normal, fair way is reducing balance, where you only pay interest on the money you still owe. But some lenders use something called a flat rate, where you pay interest on the entire original amount for the whole loan, even as you're paying it down. A 7% flat rate can easily cost you more than a 12% reducing rate. You have to check the fine print on this. And finally, the fifth lens is nature. Is the interest rate fixed or is it floating? A fixed rate is predictable. Your payment will never change. A floating rate is tied to the market, so it can go up or down over the years. You usually see these on really long-term loans, like mortgages.
So now that you've got this 5-lens framework, let's wrap up with a couple of non-negotiable, essential rules for borrowing smart.
If you remember only one thing from this entire explainer, please make it this. Understand the hidden power of tenure. Banks love to offer you a longer term because it makes the monthly payment look so small and affordable. But look at this chart. The longer the tenure, the more you pay in total interest. It's not just a little more, it's a lot more. Doubling the tenure from 10 to 20 years more than doubles the cost. Always aim for the shortest tenure you can comfortably manage.
And have you ever wondered where your first payment actually goes? Here's another crucial insight. In the beginning of a loan, almost all of your monthly payment is just feeding the interest. Look at this example. Nearly 60% of your first payment is just interest for the bank. It barely touches the actual debt. This is why it can feel like you're just treading water for the first few years.
So at the end of the day, the power is all in your hands. A loan isn't good or bad. It's just a tool. And now that you know its parts, how to analyze it, and the rules of the road, you get to decide. You get to write the story of whether that tool builds you a better future or becomes a cautionary tale.